The world is once again facing a financial crisis. Markets are plummeting, investors are worried. It feels like 2008 all over again, but this time the causes are different. We need to understand these causes to protect ourselves. Remember, knowledge is power. In times of crisis, it's even more important to be financially literate. We need to understand the forces at play. Only then can we make smart decisions. This isn't about panicking, it's about being prepared. This essay will guide you through the storm. We will explore the causes of this crisis, and we will discuss how to navigate these turbulent times. Keep in mind, in every crisis lies opportunity. Let's learn how to not only survive but thrive in this challenging environment. The NASDAQ is a key indicator of the tech industry's health. Recently it's taken a nosedive. This decline signals trouble in the tech sector, and since tech plays a huge role in the global economy, it's bad news for everyone. The NASDAQ's fall is significant. It's not just a small dip. We're talking double-digit percentage drops. This kind of decline should set alarm bells ringing. It tells us something is fundamentally wrong. Many factors contribute to this decline. High valuations are a major concern. Some tech companies were overvalued. Their stock prices didn't reflect their true worth. When reality set in, the market corrected itself. This correction is a painful but necessary process. It's like letting the air out of a balloon that's about to burst. It's better to have a controlled deflation than a chaotic explosion. The Nikkei index reflects the performance of the Japanese stock market. Like the NASDAQ, it too has experienced a significant fall. This decline shows that the crisis is global. It's not just limited to the US. Japan is a major player in the global economy. Its struggles have ripple effects across the world. When the Japanese market sneezes, the rest of the world catches a cold. The reasons for the Nikkei's decline are complex. They include a slowdown in the Chinese economy, Japan's largest trading partner. This slowdown has impacted Japanese exports, hurting businesses and the overall market. Additionally, Japan has been grappling with deflation for years. This persistent deflation has made it difficult for the economy to gain traction, and it has made the stock market more susceptible to shocks. One of the key drivers of this crisis is high price-to-earnings PE ratios, which have reached unprecedented levels in recent times. In simple terms, the PE ratio tells you how much you're paying for every dollar of a company's earnings, providing a snapshot of its valuation. A high PE ratio can indicate that a company is overvalued, suggesting that its stock price is higher than its actual earnings justify. Think of it like buying a house. If the price is too high compared to its actual value, you might be stepping into a risky investment. If you pay way more than the house is worth, you're in a bubble, which can burst and lead to significant financial loss. The same principle applies to stocks. Overpaying for stocks can create a precarious situation. When investors pay inflated prices for companies, it creates a bubble in the stock market, driven by speculation rather than fundamentals. This bubble can burst at any time, often without warning, leading to a sudden and severe market correction. And when it does, it leads to a sharp decline in stock prices, causing panic and significant financial losses for investors. This is what we're seeing now, as the market adjusts to more realistic valuations. The PE ratios of many companies were unsustainably high, particularly in the tech sector, where speculation was rampant. The market correction was inevitable, as prices needed to align with actual earnings and growth potential. Investors need to be wary of high PE ratios, as they can be a red flag for potential overvaluation. It's a warning sign that a company might be overvalued, and caution should be exercised. Don't get caught up in the hype. Always question whether the price you're paying is justified by the company's actual performance. Do your research and invest in companies with sound fundamentals, ensuring that your investments are based on solid financial ground. The inflation monster roaring back to life. Inflation is another major concern. For years we've enjoyed low inflation, but now the inflation monster is back. Prices are rising, and it's eating away at our purchasing power. Inflation makes everything more expensive. From groceries to gas, the cost of living is going up. This puts a strain on consumers, and it can lead to a slowdown in economic growth. Central banks around the world are trying to tame inflation. They're raising interest rates, but this can have unintended consequences. Higher interest rates make it more expensive to borrow money. This can hurt businesses and slow down the economy. We're in a delicate balancing act. Central banks need to control inflation without triggering a recession. It's a tough job, and the outcome is uncertain. Geopolitical earthquakes shaking the markets. Geopolitical tensions are also adding fuel to the fire. The world is a volatile place. Conflicts and tensions can erupt at any moment, and these events can have a significant impact on the global economy and financial markets. For instance, the ongoing tensions between Iran and Israel are a cause for concern. Any escalation in this conflict could send shockwaves through the global economy. It could disrupt oil supplies, leading to higher energy prices and economic instability. The war in Ukraine is another example of how geopolitical events can impact the markets. The war has disrupted supply chains, fueled inflation, and created uncertainty in the global economy. Investors need to be aware of these geopolitical risks. They can't be ignored. It's important to stay informed about global events and assess their potential impact on your investments. The election year jitters, Trump or his rival? The upcoming US elections are another source of uncertainty for the markets. The outcome of the election could have a significant impact on the US economy and, by extension, the global economy. If Trump is re-elected, he's likely to continue his policies of tax cuts and deregulation. These policies could boost economic growth, at least in the short term. On the other hand, if Democrats win, they might pursue different economic policies. These policies could range from increased government spending to higher taxes on corporations and wealthy individuals. The market hates uncertainty, and elections are all about uncertainty. Investors are unsure about the future direction of the US economy. This uncertainty can lead to volatility in the markets. A time for prudence. Protecting your portfolio. In these uncertain times, it's more important than ever to be prudent with your investments. Don't panic, but don't be reckless either. It's a delicate balance that requires careful consideration and strategic planning. Here are some tips to protect your portfolio. Diversify your investments. Don't put all your eggs in one basket. Diversification is key to managing risk. Spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. Rebalance your portfolio. As market conditions change, your portfolio's asset allocation will drift. This can expose you to unintended risks. It's important to rebalance your portfolio regularly to ensure that you're still comfortable with the level of risk. Regular rebalancing helps maintain your desired risk level. Consider investing in defensive assets. Defensive assets, such as consumer staples and utilities, tend to hold up better during economic downturns. They provide stability in turbulent times. These companies provide essential goods and services that people need regardless of the state of the economy. This makes them more resilient. Don't try to time the market. It's impossible to consistently predict when the market will go up or down. Market timing is a risky strategy. Instead of trying to time the market, focus on investing for the long term. A long-term perspective can help you ride out short-term volatility and achieve your financial goals. finding opportunities where to invest now. While it's important to be cautious during a financial crisis, it's also a time to look for opportunities. Market downturns can present unique chances to invest wisely. When the market is down, there are often bargains to be found. Savvy investors know that downturns can be the best times to buy. Here are a few areas where you might find investment opportunities. Value stocks. Value stocks are companies that are trading at a discount to their intrinsic value. These stocks are often overlooked. These companies might be overlooked by the market but have strong fundamentals and potential for growth. Emerging markets. Emerging markets such as China and India are still growing at a faster pace than developed economies. They offer unique opportunities. While they come with higher risks, they also offer the potential for higher returns. Real estate can be a good investment during times of inflation. As prices rise, so does the value of property. The value of your real estate holdings is likely to appreciate. Gold. Gold is often seen as a safe haven asset during times of economic uncertainty. It provides a hedge against inflation. It tends to hold its value well during market downturns, making it a reliable investment. Conclusion. Political rivals Democrats versus Trump. The Democrats are gearing up for a fierce battle against Trump. Kamala Harris is emerging as a key figure. Her influence is becoming increasingly noticeable in the political landscape. How can the choices made by American voters impact the global economy? The decisions made at the ballot box not only shape national policies, but also have far-reaching consequences that affect you, me, everyone watching this video, and even those who consider themselves non-political. This is not the time for complacency. It's the time to be informed, prepared, and proactive. Remember, political battles are a natural part of the democratic process. They come and go. The key is to learn from them and come out stronger on the other side. Don't be afraid to seek professional advice if you need it. And remember, the most important investment you can make is in your political education. Subscribe to the Rich Roadmap channel and visit our website for more insights and strategies to navigate these challenging political times.